So I'm going to kick things off with kind of just setting the space with just some basic understanding of, first of all, good debt versus bad debt. And I'll be talking more about how to leverage your existing real estate and how to create some tax deductibility and also use it as a wealth building tool. Most people in Canada have a majority of their wealth allocated towards their principal residence. So we're going to be talking about a way to add a multiplier to that. One of the reasons why people make so much money in real estate is because of leverage. So we'll talk a little bit about that and a different way to leverage debt in order to build your wealth. Okay. So kicking things off here, I wanted to just set the stage for what is there. Obviously debt is debt. It is an expense in most cases, but we can actually utilize debt in a positive way. Oftentimes, there's a stigma attached to, whether it's credit card debt, mortgages. People tend to want to pay their mortgages off as fast as possible, but in certain scenarios, that might actually not be the best strategy. So we'll talk a little bit about how your home can be leveraged as a wealth building strategy. So if we're taking a umbrella look at good debt, we're looking at basically real estate, investing in yourself through education, as well as business investments. The reason why we consider these categories as good debt is because it pays you down the road. Bad debt, we basically tend to classify that as anything that is depreciating or is going to just cost you money in perpetuity and is not going to pay you anything back in the future. Some people would say, well, cars could be debated because now we have something called Turo where you can actually turn a vehicle into cash flow. But for most cases, if we're talking about, a vehicle that you're using on a daily basis, typically if you're leasing that vehicle or if you're financing it, typically it's going to be seen as bad debt because a car is a depreciating asset. Okay. Credit card debt is one of the first areas we look to eliminate your debt because some credit cards have what are called more preferred or lower interest rates, but in most cases you're looking at a 22% interest rate that you're carrying. So we're going to talk about a little bit about when should you pay your debt off faster versus not. And with credit cards, in any case, you're probably going to want to eliminate credit card debt as soon as you possibly can. Okay. So taking it one step further on the same topic here. So just further classifying this, good debt typically has low interest rates. It's especially favorable if you can find a way to make that interest tax deductible, which Derek is going to go into in more detail. Typically, as I mentioned before, typically used to buy something that has value or can create some sort of cash flow or income for you down the road. A key factor here when you're looking at maybe if you don't own real estate already or if you're looking to expand your real estate portfolio, you want to be managing your debt in a way where it's not going to basically bite you in the butt down the road because we have to be careful about your debt service ratios. Okay. So there's two things that I think Derek will typically look at would be GDSR and TDSR when it comes to qualifying for mortgages. I'll get to that down the road there, Joe. Thanks for the question. Total debt service ratio is looking at all the debt that you're carrying and basically what's the ratio of your income to how much you need to pay down on that debt on a monthly basis. Okay. If we're looking at GDSR, that's more specific to your actual real estate. So your income versus how much, you need to fork out every month to pay your mortgages. Okay. Bad debt typically will have high interest rates like credit cards, used for something that doesn't have a future value. So depreciating asset like a vehicle. And typically it may increase your total debt service ratio. Okay. Now I get this question all the time. Whenever I, onboard a new client or if we have a review meeting, often we take a look at cash flow. And one of the questions that consistently comes up is I'm carrying some debt. Should I, I have some savings maybe sitting in a checking account or in my investment account. Should I maybe, deplete some of my savings to pay down my debt to increase my cash flow? And the answer is always it depends. So what we take a look at first off is what is the interest rate of the debt that you're carrying? So on in the good debt category, typically you're going to find lower interest rates. In the bad debt category, like credit cards, you're going to have higher interest rates associated with that. So if we take a look at average returns in the investment marketplace, we're looking at hopefully your investments are at least outperforming inflation. So we're looking at 2 to 3% on a conservative portfolio at minimum. Whereas if you're going with something more aggressive, the long-term average of the stock market tends to be around 10% on a historic basis. So when we look at if you have existing savings or investments, what is the expected rate of return that we can achieve based on where you land on the risk spectrum or the risk exposure of your portfolio, and compare that to the interest rate that you're carrying. So in this example, what we're taking a look at is a mortgage in particular, and the factor here was a 4.5% mortgage rate. So if we take a look at, and this is, by the way, if there's anybody who likes to look into the weeds of taxation, what we're looking at here is a tax sheltered account like a TFSA or RSP. So without going too much into the numbers, if we can outperform your mortgage rate of 4.5%, so if we're able to perform, your investments are able to perform at a rate of 5% or more, it's going to make sense for you to continue to invest and just make your minimum payments on your debt. Okay. So if we take a look at that, worst case scenario, right? Your positive spread, right, or your net investment return is going to be 0.5%. So if you detach emotion and we just take a look from an analytical view, if we can create some sort of positive return, even though you're carrying the debt, it's going to make sense for you to continue to hold your investments and allocate money towards your investment portfolio. Okay. So now we kind of take a look at, taking it a step further, not just looking at the numbers, but also what is your risk tolerance? So when you're carrying large amounts of debt, you have a few different areas of risk exposure there. For most people, the majority of your cash flow is going to be coming from employment income. So one of the risk factors there is what happens if you get laid off. Do you have the ability to continue to service your debt? That's a risk factor. Risk capacity, right? So if you're nearing retirement, maybe we want to take a look, 5 years coming up on retirement, do we want to switch your strategy for maybe now prioritizing debt payments if your capacity, meaning how long you can carry these payments for, is not a long period of time? Okay. Third factor there is bad debt. As I mentioned before, we want to eliminate bad debt as soon as possible because that's not adding to your net worth, and it's not going to be a positive thing for you down the road. Okay. We talked a little bit about GDSR, gross debt service ratio, and TDSR, total debt service ratio. So these are the numbers you kind of want to keep in mind. Derek, let me know if these are on par with kind of the underwriting process for mortgages. But typically, from what I've seen, you kind of want to keep your GDSR above or below, rather, 32%, and TDSR below 40%. Would you agree with that?
We have 39 and 44 is the numbers.
39 and 44. Okay. So depending on who you're dealing with, whether you're going directly to the bank or whether you're using a mortgage broker, those rates or those ratios may change depending on the lender, right? But if you just kind of want a rule of thumb, obviously the lower it is, the more favorable you're going to be positioned for underwriting a mortgage. You may want to consider investing if you have a higher risk tolerance and higher risk capacity. Time horizon at minimum, I would say, is 5 years. But if we're looking at some sort of leverage to invest strategy, which I'll talk about, we're probably looking at more of a 10-year time horizon. Okay. The longer you have to invest, the more beneficial it's going to be for you long term. Okay. So leveraged investing. So this is an interesting strategy. It's a little bit more complex. Basically, the way you can think about this is leveraged investing is a borrow to invest strategy. So basically, you borrow money in some capacity. One option is you tap into the equity of your home and you use some of that capital to redeploy into an investment portfolio. Okay. So the CRA rule is if you borrow money for the purposes of producing some sort of cash flow, whether that be purchasing a business, expanding your business, purchasing income producing investments such as dividend paying stocks, that can create a tax deductible expense in terms of the interest that you're going to incur. Okay. When you create a tax deductible expense, that will reduce your tax bill if you're holding any income producing assets inside of a non-registered portfolio. Okay. Upsides versus downsides. Really the key, and most people understand this in a real estate context. Again, as I mentioned, the reason why people make so much money on real estate is because you're able to put down, let's say $100,000 and buy a $500,000 property. You don't need all $500,000 in cash in order to buy the $500,000 asset. So if the property value grows at 5%, that's going to amplify your returns. Okay, so you're not just earning 5% on your 100 grand, right? It's going to be multiplied by, basically how much you put down. Okay, so you're able to increase your ROI that way. More capital you have invested, of course, the greater the growth potential. So if we take a look at long-term averages, if we're able to, achieve a 10% investment return, let's say you have 50 grand in cash and you've borrowed 50 grand, so your portfolio is 100 grand and we make 10%. Now your portfolio has grown to 110,000, but you've only put in 50 grand of your own capital. So again, that's another way to increase your ROI. Okay, tax deductibility is massive. And this, in a nutshell, is going to really just accelerate your long-term wealth building plan. Okay. The downside and risk factors really, when you're using leverage in order to invest, that can also magnify your losses. Okay. Which we'll take a look at here. So again, not getting too much into the numbers here. Basically what this is illustrating is a gain versus loss position of 6% with borrowing versus without. Okay. So if we look at $100,000 of an initial investment with half of the capital being borrowed, whether it's from a HELOC or directly using an investment loan. If you're able to earn a 6% return, right, you're going to make $6,000 on 100 grand, but you've only put 50 grand of your own capital. Okay. We do have to factor in, taxes if we're holding this inside of a non-registered account. So your net after tax gain with borrowing is going to be about $1,500. Okay. If you end up, if the stock markets don't perform well and we incur a loss of 6%, well, that's going to magnify it, right? So now we're looking at a $3,900 loss versus a $1,500 gain, even though, the numbers are basically similar at 6% on a gain versus loss basis. Okay. So again, I have noted, this is not a strategy that you want to employ if your time horizon is only 1 or 2 years, right? Markets are volatile. So we'll take a look at a quick graph here. Okay. Over a 10-year basis, basically you could have thrown a rock in any single investment marketplace and you probably would make money. So what I have illustrated here is the gold index, the NASDAQ, the S&P 500, and a GIC performing or offering an interest rate at 4% renewable. Okay. So even if you went with the most conservative option at 4%, of course you would have made money. If you went with the most aggressive option, gold didn't really do too well over the past 10 years. But as you may have seen, year to date, gold has absolutely crushed, because whenever people are uncertain about stocks, they tend to redeploy their money into gold. Okay. If we take a closer view, year to date, right, the only thing positive, utilizing the same examples, is really gold and the GIC. Okay. So if we're looking year to date, and you have a short-term time horizon and you're taking on a very high-risk strategy of leveraging to invest, you might end up in hot water if the markets are not performing well. Okay, so we always want to take a long-term view, 10,000-foot view on kind of what's going on and what you can expect when you invest, to make sure that we have enough time under our belt in order to incur the interest expense and give, our investments enough time to kind of do their thing. Okay. So I kind of went through that a bit quick and dirty. I'll just pause there to see if anyone has any questions. I know Jillian, you asked a question about credit cards. So isn't credit card debt compound interest, i.e. interest on interest? Absolutely it is. Okay, most forms of debt will compound. So that's a snowball effect. So if you're not paying off your credit card on a monthly basis, then the interest expense is going to be compounded. Right. So what I mean by that is if, let's say you have 20 grand sitting on a credit card and you're incurring, a 20% interest rate. Even if you pay down 10 grand, you haven't paid off all of the interest expense. Right. So that's going to compound and increase your debt and make it more difficult to pay long term. Good question, Jillian. Okay. Any other questions before I pass it over to Derek to go a little bit deeper on this stuff? All right, Derek. Well, the floor is yours. I'll just say first off, Derek and I have been kind of passing business back and forth for the past couple of years. I think we met maybe 2.5, almost 3 years ago now at a coffee shop. And, Derek has been kind of my go-to in the mortgage space He's based here in London, and he's incredible at what he does. If you're not on his newsletter, I suggest you get in contact with him, and he shares a lot of useful information with regards to freeing up cash flow, how to optimize your debt associated with your real estate, and just some interesting ideas on how you can, basically put yourself in a better position, even if you feel like you're in hot water and it's difficult to pay your mortgage right now. You just told me about a client he helped where he was able to free up like $1,700 in cash flow just by taking a look at the options available and doing some hard work for the client. So Derek, please, I'll pass the mic over to you and feel free to go into it.
Thanks, Bronson. Before I get into the presentation itself, I will just touch on the Bank of Canada announcement today. They held their interest rate, which we fully expected. And the name of the game right now really is uncertainty. I sat in on a presentation a month or two ago, and I can't remember what the exact count was, but somebody counted the number of times the word uncertainty showed up in the Bank of Canada's monetary policy report. And like a year ago, it showed up next to no times. And then over the past few policy reports, it showed up literally like 74 times in a single report. So the challenge for everybody right now is uncertainty. No one knows what the hell is going on, what's going to happen. And if anybody speaks to you with any sort of certainty, they're lying to you because nobody knows. With the Middle East stuff going on, and every single day Trump does something different, and it causes people to panic. I'm going to get into it over the next couple slides here. Actually, we'll get right into it. Let's go to the next slide there, Bronson. So the real goal for me now and any clients that I speak with is financial flexibility, because it's that flexibility that helps you get through these uncertain times. So when I talk about flexibility, I'm talking about essentially like as a homeowner, your access to that equity. Because if you don't have access to the equity, it essentially doesn't exist to you, right? So when you are more financially flexible, it allows you to invest more. You can handle volatility, which is exactly what we're dealing with right now. People losing their jobs, the cost of living going through the roof. Like, people are wondering if we're going to hit $2 a liter in gas this year, right? It seems like every single day that those gas prices keep going up and up. So when you have that flexibility to access that money, you sleep better because there's less stress. You're not worried as much about things because you have that safety net, you have that access to money. And it allows you to be proactive with your decisions instead of being reactive, right? If there was the market crashes, which it has fairly recently, right? That's an opportunity to dump more money into the market, right? And if you don't have access to that equity, then you kind of miss the boat there. Next slide. So where does cash flow get crushed? These are real numbers from a recent client of mine that Bronson mentioned. So they had a $290,000 mortgage, $121,000 in unsecured debt, and a $70,000 HELOC on that property as well. Their total expenses per month just for managing the debt was $58.20 a month. Okay. Next slide. This client came to me. This is a personal friend of mine too. So he came to me, it was probably almost 2 months ago now. He's like, hey, I got a renewal coming up in July. Can you help me out? I'm like, absolutely. So we look at all the numbers, and as soon as I looked at everything, pulled his credit and all that sort of stuff, I gave him a call right away and said, hey, dude, we're not waiting until July to do your renewal. We need to refinance right now because there's a huge opportunity for you. The penalty for him to break his mortgage 4 months early was like $2,000. But this is what was happening here. So the rates on all of the non-mortgage debt he had ranged from 6% to 22%. We consolidated all of that, brought it down to one single payment at 4.34%. His payment went down his total household payment went down $1,700. So that's factoring in the mortgage that he had, car loans, lines of credit, the HELOC, all that other debt rolled into one payment was increasing his cash flow $1,700 a month, which is obviously huge. Now, what he does with that is entirely up to him. But we have conversations about, okay, well, what do you do with that money? Do you take that $1,700 and do you rapidly pay down that debt? Or do you take that $1,700 and throw it in your investment portfolio? And as Bronson said, the smarter move in this situation would probably be to throw that $1,700 into his investment portfolio and let that grow and build, because his interest on the debt is 4.34. Surely he's going to bring in more than 4.34% on an investment portfolio. So huge savings there. And this is kind of what I like to do with all my clients. Sure, I help people with pre-approvals and buy houses and whatnot, but my bread and butter is in debt consolidation now and restructuring people's finances. Sorry, you
sorry to change the screen on you there, Derek. I wanted to add some additional context there. Can you help me out and understand how old this client is?
He's a little younger than me, so I would say 41.
41? Okay. So let's just say he wants to retire in 20 years. Okay, so you've been able to free up $1,700 a month. If he chose to invest that for the next 20 years before he retires, that's $1 million he would have in savings by doing what you just did. If he redeploys that capital of $1,700 a month into an investment portfolio that, let's say it's an aggressive portfolio and we use a conservative assumption saying we can earn him a rate of return at 8%, he now has $1 million in savings that he can use in retirement. Obviously, we're not factoring in taxes here, but those are gross numbers.
You're stealing my thunder. I think that was my next slide.
Sorry, buddy.
All good. So here's the compounding effect of cash flow, right? So we freed up $1,700 a month that this guy was paying out. If he gets a very minimal 6% return on that over 20 years, that's a $785,000 return, right? And that kind of matches up, because I think Bronson was just using 8%. So 6% is very reasonable, I think. So freeing up cash flow today can build serious wealth tomorrow, right? That's the big take-home message there. Next slide. Okay, so the renewal strategy. The reason I wanted to just touch on this is because there's over 1 million mortgages up for renewal this year. 2025 and 2026 are huge renewal years because of COVID and the craziness that happened in kind of late 2020, 2021, early 2022. People went crazy with buying homes. They over leveraged themselves. They didn't pay attention to lifestyle, and then lifestyle creep came up, and now all of a sudden they've got these renewals coming up where their interest rates are, at minimum doubling, right? It doesn't mean their payments doubling, but their interest rates definitely doubling overnight. And it's having a big impact on their cash flow. Now, I will say, when we qualified these buyers, when they were buying at the peak, we had to stress test them at 5.25%. So even if they got their fancy 1.75% interest rate fixed for 5 years or something like that, we still had to debt service them, or stress test them, at 5.25. So in theory, they can handle that mortgage at 5.25%. So when they come up for renewal now, and they're getting a low 4%, they should be okay. The problem is, over the 5 years, they got comfortable with what their payment was at 1.75, and then they took on a car loan, or they bought a trailer, or they vacationed, and they did this, and they didn't think about their mortgage coming up for renewal 5 years later and knowing that they're not going to get 1.75. So people are running into some challenges right now with cash flow, and we're having to come up with some solutions for them. And sometimes the solutions are extremely difficult, where they're almost forced to sell. Other times people have equity built up in the home, and we have options with refinancing and re-amortizing to free up some cash flow. So if you are in a situation where you have a renewal this year, there's a 120-day window that we want to pay attention to. Because of how volatile interest rates are right now, you want to secure an interest rate that we can hold for 120 days. And in doing that, it protects you from rising interest rates. And you also have options if, for whatever reason, interest rates come down over the next 4 months, which I don't see happening, but if they did, we can float those rates down as well. So this is a win-win. Like if you have a renewal coming up, you should not be waiting until your bank reaches out to you, because they're not going to reach out to you until it's too late. Their whole goal is to make as much money off of you as possible. So they might reach out to you, 3 weeks before renewal, and they'll say, hey, here's your interest rate option. Meanwhile, 4 months ago, they probably could have got you a better interest rate, but they're not going to tell you that because it doesn't make them as much money. So secure an interest rate now and hold it. It doesn't mean you have to take that rate or go with that lender. It's about protecting yourself against the volatility that we're dealing with right now. This also gives you options. So if you hit, let's say you've got a renewal coming up in 6 months, and I can only hold the rate for 120 days, so 4 months, but you secure that rate right now. If we get to the end of that rate hold period and you still have 2 months to your maturity date, well, if I held an interest rate at, say, I don't know, throw a number like 409. Let's say I held 409 for you today. And then in 4 months, interest rates are at 4.5%. Well, then a decision needs to be made. You might want to refinance at that point or break your mortgage early, right? So you're only going to have 2 months until maturity. The cost of breaking your mortgage at that point should be fairly affordable, and you will have secured that 409 interest rate instead of waiting 2 months to get, essentially your free renewal, but you're going to be at 4.5% interest rate for the next 3 to 5 years. So taking action early gives you the freedom and flexibility to make decisions down the road. That's the big take-home message there. And your renewal period is the biggest time to look at restructuring your mortgage too. So you reevaluate your debt position, where things are with that. Because if we do set up a refinance at your maturity date, there's no cost to doing that because you're not breaking your mortgage. So you don't have to worry about paying larger legal fees or paying a penalty to break your mortgage either. Next slide. And this is your renewal decision tree. So every time you're up for renewal, you have a couple decisions to make. Do you want to reduce your payment by extending your amortization, which is going to lower your monthly payment and increase your cash flow? Now, doing this obviously increases the overall cost of owning the home because you're extending that amortization. You're taking longer to pay off that debt. So there's pros and cons, right? You're increasing cash flow, which might be what you need right now, right? And that's okay, because down the road, when things are better, you can also re-amortize again in the other direction to get back on track. So this is where people don't really understand how valuable a mortgage tool can be. You can go both ways. So if things are tight right now and you own a home and you have lots of equity, you have options, right? And that's what helps you get through these volatile times right now. So say you've got 15 years left on your mortgage and you're up for renewal and things are maybe a little bit tight. Well, let's re-amortize your mortgage back to 25 years. We're going to throw 10 years back on that debt. That's going to decrease your monthly payment a couple $100. It might even be more depending on how big the mortgage is, that you get freed up. So that can help with, your groceries, gas, like lifestyle expenses. And then when we get through this mess, or, you get a promotion, you're making more money, you're in a better spot. There's no reason why down the road, you can't just go back to the 15 years now that you're back on track. So use the tool to help you get through the tough times, right? When you renew, you can maintain your payment, which is going to allow you to accelerate the equity that you're building up. Believe it or not, there are some people whose interest rates are going down because, you know, maybe they did a 3-year fixed a couple of years ago and they got caught at a time when interest rates were over 5%. So they're actually renewing at a lower interest rate right now. So in that situation, if you're going from a 5.25 down to, you know, a low 4s, if you can handle the 5.25%, then there's the option of just keeping your payment the same, which is going to accelerate paying down your debt, right? And then the last option is to restructure the debt, right? So consolidating non-mortgage debt, adjusting the product mix, you know, throw Manulife One in there, consider a HELOC. There's all kinds of different things that we can do, and it really depends on who you are, what the household looks like, and what your short and long-term goals are, right? And these are conversations that I have with all of my clients to help them make the best decision for them. This is not about, you know, what's the best interest rate available right now. If that's all somebody is asking you, they don't know what they're doing, right? There needs to be a way bigger conversation because your renewal period is really such a huge opportunity to change things essentially for free, right? And you know, you can keep it there, it's fine. I'll just say that conversation when you come up to maturity, on top of having that conversation with myself in terms of helping structure that, you would also want to be having a conversation with Bronson, again, just looking at your overall goals, right? And talking to your accountant too, and what that looks like from a tax perspective. Next slide. So Bronson covered this a little bit. I'll just dig into it a little bit more. So the difference between good debt and bad debt. I look at bad debt, as non-deductible debt. So this is it's kind of a little bit of a nuance for real estate. So Bronson had a home loan as good debt. I look at your primary mortgage as a little bit of both. Sure, it's an appreciating asset, but it's also non-tax deductible. So if you own multiple properties, I'm going to touch on this shortly, there are strategies that you can use where we can convert your primary mortgage into a tax deductible loan. And we'll talk about that in a little bit. Yeah, so consumer-based debt, you know, your credit cards, car loans, all that sort of stuff. Whatever you're buying not being an asset, you know, obviously that's bad debt. And your good debt is your income producing products, potentially deductible and supporting appreciating assets. Next. Okay, so we're going to get a little bit into some more advanced strategies here. So for multi-property owners, you want to look at an overall portfolio view instead of just looking at each individual property, right? So we're going to look at all the properties that you have, look at the structures of each of those mortgages and look at it holistically as opposed to just one individual property at a time. We want to look at interest deductibility of those mortgages, and that's going to depend on whether they are rental properties or second homes or your primary mortgage. We look at all that. And then your equity extraction, right? What makes most sense? Which properties are better to borrow from to improve your liquidity or even just improve access to that equity? So once you have more than one property, the overall debt structure of those mortgages becomes even more important and part of your overall tax strategy as well. Next slide. So most people, or I'll talk about this in the next slide. So Smith maneuver. The next two things that I'm going to talk about, Smith maneuver and rental cash damming, they're really kind of the same strategy. It's just the Smith maneuver is related to investing and rental cash damming is related to real estate. So the Smith maneuver is, and Bronson touched on this already, you're borrowing for the purposes of investing, and Canadian tax law tells us that that debt is now tax deductible. So with the Smith maneuver, it's important to have the proper mortgage structure or the proper mortgage product ahead of time to make this easier. And we want to use what's called a readvanceable HELOC. And there are different types of HELOCs out there. Not all HELOCs are readvanceable. So if you don't have a HELOC at all, having one is beneficial. The HELOC stands for home equity line of credit, if you're not familiar with that. And the interest rate on HELOCs are cheaper than a personal line of credit. And the reason for that is because the HELOC debt is secured to your home, whereas a personal line of credit is unsecured. So you'll get a way better interest rate on a HELOC than you will on just a personal line of credit. So the readvanceable HELOC is every dollar that you pay down your primary mortgage, that dollar is still available for you to borrow. Okay, so hopefully that makes sense. So if I've got a $100,000 mortgage and I put $5,000 down towards it, I have a $95,000 mortgage now, but that $5,000 that I just paid down on the primary, that becomes available to borrow, right? The maximum size of a HELOC you can have is 65% of the value of the home. And the total debt between the HELOC and the actual mortgage itself, that combined debt cannot be more than 80%. Okay, but going back to the Smith maneuver, so we want a readvanceable HELOC because every dollar we pay down the mortgage, that dollar is available to borrow. And what people do with the Smith maneuver is they pay down that debt. So they pay down the primary mortgage, they re-borrow that money that they just paid down, and they invest it. So their total debt actually doesn't change. And this is where, you know, people have to understand the risk, right? You're leveraging, right? So your debt load is not changing because you're paying $5,000, but you're taking $5,000 out right away. So the debt stays the same throughout that whole life of you running the Smith maneuver. But the benefit is all that money that you borrow from the HELOC now becomes tax deductible, right? And you're building an investment portfolio at, we hope, a higher interest rate than the cost of the debt. That's the Smith maneuver in a nutshell. You want multiple people involved in doing this. So you want someone like Bronson who knows, you know, the risks and rewards of a Smith maneuver. You want a mortgage broker that knows how to set up the mortgage properly so that you can run the Smith maneuver effectively. And you also want your accountant on board with this as well, right? So you need your financial team in place to have the Smith maneuver run effectively. Okay, next slide. Rental cash damming. Ignore the picture, like the numbers on there, they don't mean anything. It's really just a filler image. Rental cash damming is the same kind of idea. It's essentially a Smith maneuver for rental properties. So if you have a rental property, let's say you have one rental property. You've got a primary mortgage, the house that you live in, and you've got a rental property that you rent out. What most people do, 99% of the people out there, they take in that rental income and they use that rental income to pay the rental mortgage. Okay. The rental property, the expenses and interest on that rental property are tax deductible. Your primary mortgage is not tax deductible. So we want to change that. And that's where rental cash damming comes in. So on your primary mortgage, we set up that readvanceable HELOC, like you would do if you had the Smith maneuver. And then you just change the cash flow, the cycle of where the money is coming from. So rental cash damming does not cost you any money. You're redirecting the flow of money. So you take in that rental income you treat as a prepayment privilege on your primary mortgage. Everybody's mortgage should have one. It's usually 15% or 20% of the original loan amount per year that you can put down. So let's say you've got a $3,000 mortgage and you've got a rental property that's bringing in $3,000 in rent per month. you are effectively making a $6,000 a month payment on your primary mortgage, but you're going to re-borrow all of the money that's related to paying the debt on the rental property. So the mortgage payment on the rental, the property taxes, potentially utilities, maintenance, anything related to that rental property, you're borrowing from your primary and you're moving that money into what we call a clearing account, which is really just another checking account. And we do that to create the paper trail, because you need to prove that the money that you're borrowing from your primary is for the purposes of investment, which is true because you have a rental property that's an investment property. So it's the same kind of idea, except instead of deploying the borrowed money into the stock market, you're deploying money into your rental property. But it's the same kind of strategy. Hopefully that's making sense. Did I miss anything on there? Yeah. Okay. So with rental cash damming, it's really kind of a two-stage process. So the first step is converting the debt into a HELOC, converting your mortgage into a HELOC. So you're going to start this strategy with, let's say you've got a $300,000 mortgage and you've got no balance on your HELOC. So you're going to pay down the primary mortgage, and at some point, call it 6, 7, 8 years down the road, you'll have zero mortgage, but you'll have close to a $300,000 HELOC, right? But that $300,000 is fully tax deductible, whereas before the $300,000 was not. Okay, so once you've moved that over to the HELOC, then you start taking that $6,000. Right? I'm just using random numbers here, but assuming you had the rental income at $3,000 and your mortgage payment was $3,000, you are rapidly paying down that mortgage. Once it's converted to a HELOC, now you're taking that $6,000 and you're paying down the HELOC, right? And at some point you'll be at completely zero. You'll have no HELOC balance. You'll have a primary mortgage that's completely debt-free, and you'll have a rental property that still has some debt, but we're not worrying about that because it's fully tax deductible. So we just let the rental property follow its amortization schedule and be done with it. The whole purpose of rental cash damming is we're unlocking the tax deductibility of the primary mortgage, because on its own, it is not tax deductible. It's arguably bad debt, right? Even though it's debt against an appreciating asset, we can improve that debt by making it tax deductible. That's rental cash damming in a nutshell. And there's really only a couple lenders where we can set that up because of the readvanceable component and how certain lenders treat your prepayment privileges. There's a lot of lenders that have HELOCs, but they only allow you to make a payment on that. They only allow you to do that prepayment privilege once a year at maturity, right? Whereas other lenders allow you to make those monthly payments. So you want to make sure that you have the right mortgage structure for implementing this. Next slide. Yeah, okay. So when does the conversation make sense, right? When are you going to reach out to me? If you have a renewal in the next 18 months, I think it's worth a conversation just to get everybody on the same page and thinking about things. And also opportunities for me to uncover opportunities right now, right? Especially if you're carrying any non-mortgage debt and you're just unaware of your options from a debt consolidation perspective. If you're carrying on unsecured debt and you own a home, we should be having a chat right now. If you own a rental property, we should be talking right now. If cash flow is tight, even though you have good income, we should be talking right now. And if you're seeking better tax alignment, then we should be talking right now, right? I offer a structured mortgage strategy review. There's no commitment involved whatsoever. It's just me looking at your numbers and letting you know what your options are. If you've got a best friend who's a mortgage broker and you would prefer working with them, knock your socks off. I am very much an abundance mindset type broker. There's plenty of business out there. I don't compete against other brokers. I compete against the banks. I consider every broker in my industry a colleague. So I don't like to compete against them unless somebody is making a mistake and causing problems, because there are definitely bad brokers out there that try to take advantage of people. And I am not one of those people, right? So if you're happy with who your mortgage broker is and maybe they just aren't familiar with how to set up some of these structures, you can have a conversation with me and you can relay that information to them, and maybe have them give me a call and I can teach them. There's a lot of brokers out there, and they might have heard of rental cash damming, but they don't know anything about it or how to set it up and structure it properly. It's kind of shocking that so many people are not familiar with it, and it could just be because there's a bit of work involved, and you do need additional people on board to make it happen, right? You have to have an accountant in place. If you do your taxes at H&R Block, they are not helping you with rental cash damming, right? You have to have, a real accountant, I'll call it, who can help with setting up the structure for rental cash damming properly, right?
Ideally,
And then from the
someone
Smith,
with a CPA behind their name.
yeah, and on the Smith maneuver thing, for sure, you need your financial advisor in place for doing that because of the risks, right? If the investment portfolio slips, on top of you not making money, you also have this additional debt that you have to pay, right? So things can fall apart. You have to have strong finances, good budgeting skills, and a long-term vision when it comes to the Smith maneuver. But it works, and I know people that do it. It's just whether you can manage that risk and you have a team in place to help make that happen.
Absolutely.
Next slide. Okay, so that QR code is just going to take you to my website. There's calculators there. You can book a call with me on there. You can get I have a monthly homeowners report that goes out. So every client that I have, they get a monthly report that spits out the estimated value of their home, what their equity position is, and most importantly, any opportunities to save money. So when you enter in your information in there, it'll spit out right away whether you've got a good mortgage or not, right? So I've helped a whole bunch of my past clients switch mortgages in the middle of their term just because of an opportunity that popped up. I'm doing one right now for a client. They bought a home like a year and a half ago, and it was just kind of bad timing. They've got a 5.24% interest rate, and we're switching them to a 389 right now. So huge savings on the monthly cash flow side of things, which he's really excited about. Pretty substantial penalty too. So this guy is going to pay just a hair over $8,000 to break his mortgage, and he's going to pay out of pocket to do it. But that 3.89% to improve the cash flow is big for him. And the overall net interest savings over the next, I think he's got 14 months left in his term, he'll come out ahead $1,000. So he's paying $8,000 now to come out ahead like $1,000. So it's like paying $8,000 to get $9,000, right? But also his mortgage payment is going down $430 a month. So he's going to redeploy that $430 a month into his investment portfolio. So yeah, all that information is available on my site. You can book a call with me. And then, like I said, everything is non-committal. Like, I just like to educate people and have conversations. You can sign up for that report. I also have a VIP club where every month there's a mortgage article that goes out, and you just have to answer the question in that monthly email. You get entered into a draw to win a $25 gift card, or whatever large prize package I have going for the month. So I'm in this new program right now where the prizes are in the $1,000 to $1,500 range. I think last month we gave away 2 Galaxy smartwatches. So yeah, if you like the idea of entering in free contests every month, you can do that there too.
Awesome.
That's it.
Excellent. Thank you very much, Derek. So just some key takeaways that I kind of noted, a lot of different things were talked about today, right? But if you take anything away from, this webinar, I think the biggest thing is work with professionals. A lot of these strategies are extremely difficult to DIY and frankly, probably not available, right? I deal with many clients who often go directly to the bank to, take care of their mortgage renewal or get new financing for a property. But when working with a guy like Derek, you get access to strategies like this. If you step into a Scotiabank or RBC or any other bank, these are not strategies that they're going to present to you. Maybe if you ask, they might know a thing or two, but they're not going to proactively reach out to you with a strategy like this. Okay. So everything we talked about today is in an effort to help you maximize your money, optimize your money, and build your net worth. So everybody likes to save on taxes. These are strategies that will help you do that. And frankly, the two strategies that Derek talked about today, the Smith maneuver and rental cash damming, it doesn't require you to fork out any additional money per month. It actually puts more money back in your pocket, right? So it's worth a conversation as you're coming up for renewal. Absolutely reach out to someone like Derek. Again, as he mentioned, if you already work with someone and maybe they're hesitant to answer your questions about these strategies, well, then give Derek a call and maybe he can help you put yourself on the right path. Okay. So again, 3 professionals you absolutely need when you're going to look to implement any of these are a mortgage broker who knows about these strategies, such as Derek. If you don't know, there are different levels to mortgage brokers. He's a level 2, so he has access to more complex strategies than someone who would be in a level 1 category. Financial advisor, if you're going to implement something like a Smith maneuver or a leverage to invest strategy, and an accountant to help you on the tax side. Bookkeeping is massive. You can't just do this stuff without keeping records because the CRA will say, where is this money coming from and where is it going? And even though you may be implementing the strategy in your mind, if you don't have good bookkeeping records, then the CRA is not going to accept it. So I wish you all a good day. Happy Wealthy Wednesday, and I'll see you soon.